Hello and welcome to Switzer TV. Thanks for joining us. Now, on tonight's program, I'm doing a special longer look at 8 or so stocks with Mike Gable from Fairmont Equities, and we'll get to that in a minute. But before we do, a lot of people have been asking me about the Dow Jones up something like 10 days in a row. But at the same time, tech companies have been losing a bit of momentum. And so the question is, do we expect to see a reversal of tech stocks and maybe other stocks doing well, or will it bring the overall market down? Well, the interesting thing is the Dow is up only 6.3% year to date. The Australian market, the ASX 200, it's been up 5.3%. But the NASDAQ itself, that tech-heavy NASDAQ index, has been up 35.6% year to date. And so in many ways, the small pullback we saw with tech stocks last week is in many ways just a pullback linked to an overdue selling off of stocks that have done really, really well. And a lot of stocks have been ignored because they haven't been tech oriented. And I think this is what I've been expecting for quite some time, but as soon as we start thinking that the US is very much close to the top of the interest rate cycle, lots of companies that have been rejected by the market because they're interest rate sensitive are now going to start to be looked at by the traders, particularly on Wall Street, and the same sort of thing will happen here as well. And so I'm expecting the Dow to do well. I'm expecting the ASX 200 to do well from here to the end of the year, and I think it will roll into 2024. Now, of course, what we have to see is better inflation news here for the ASX 200 to really do well, and I think we're getting closer and closer to that. We know on Wednesday we see the latest CPI. I wouldn't be surprised if it comes in better than expected, but if it doesn't, the next reading, which will be in 3 months' time, is bound to be a lot better. I recently looked at the unemployment chart for the USA. Now, the Yanks have got a very good inflation number. 3% was the last reading. If you look at their unemployment and you compare it to our unemployment chart, very, very similar. It peaked, it came off, it's gone sideways, and similarly in Australia, the same kind of pattern has emerged. So the fact that we haven't seen a massive rise in unemployment doesn't mean we can't see a fall in inflation, because the Americans did exactly that. Now, the point I've also made is that because tech stocks have done very, very well, it really has been just those magnificent 7 that I've talked about before: Apple, Microsoft, Nvidia, Amazon, Meta, which of course is the old Facebook, Tesla, and Alphabet. They've been the big risers, but there's lots of other very good tech companies that could easily help the S&P 500, help the NASDAQ do pretty well. Might not get the same massive rises, but I think solid rises for them is very, very possible. Now, what about the big market issues for this week? Well, I've already mentioned CPI here on Wednesday, and then we get retail numbers on Friday. The market will be looking at this to see what the RBA might do on the following Tuesday. It'd be great if the RBA paused on the basis that they're seeing really good inflation and retail data. That's something for us to look forward to later in the week. In America, midweek, the Fed meets on interest rates, and what they do and what they say will be vitally important to what happens on Wall Street and ultimately the kickback to us, because as you know, we play follow the leader with Wall Street. So very important week for economic data. Also a big week for earnings in the US. We start to see some interesting earnings here. Rio presents, Sandfire Resources and Champion Iron, but the week after will be much more important for us in terms of earnings. In the US, we're going to see companies like Alphabet, General Motors, Microsoft, Visa, Boeing, Coca-Cola, Meta Platforms, Amazon, Ford Motor Company, Intel, MasterCard, McDonald's, Chevron, Exxon Mobil, and Procter & Gamble. So this is really going to give us a great idea of how those high interest rates have affected the company profits of some really big names in the US. And if many of them come out with better than expected results, markets will head up. Of course, if they're worse than expected, markets will go down. But I suspect we're going to see better than expected results from many of those companies. So that's the positioning. I do argue when people ask me, what's going to happen with stocks, I think the balance of things that are going to happen between now and the end of the year will be really good for stocks, and 2024 will be probably even better. But still, I think the December quarter should be good for stocks. Keep your fingers crossed that I am right. Now, let's go to Mike Gable from Fairmont Equities and look at a number of stocks and indices to see if you still should remain in this market. Well, joining me now is Mike Gable from Fairmont Equities. And we've got a number of stocks that I actually looked at last week, but I'm interested to see whether the technicals either support or don't support the suggestion that these stocks might have a bit of potential. Mike, thanks for coming to the program.
Thanks, Peter.
All right, mate, let's kick off with the first one. We always start with the big indexes. There's S&P 500, the US. What's it saying to you, mate?
Yep. Very solid performance, that's for sure. So I think a lot of people have been surprised at how well it's done this year, and the way it's trading at the moment, it's very unlikely this is a bear market rally. We've clearly seen the lows, and we are moving on. So I mean, in terms of the way it's trading, obviously it's run up pretty hard at the moment. So I'd say short term, you'd expect a little bit of consolidation. So we're getting close to the all-time high. Naturally, it might just sort of move around here sideways a bit. I think any pullbacks, if we do get some from here, will be contained within that sort of 5% sort of movement. I think there's a lot of, you only have to look at fund manager surveys. A lot of fund managers are still holding a lot of cash. They're highly
suspicious of this.
Allocated to bonds, but it's clear that we're not going back to these levels. So I think any sort of dip, they'll have to start participating. Yeah. So look, overall, this is a very good trend, overbought in the short term, but very constructive for the longer term.
Yeah, and I guess if the Fed doesn't disappoint people with too many more interest rate rises, the market can keep going higher.
Yeah, exactly.
Russell 2000.
Yeah, I thought I'd include something a bit different this time. I mean, I don't know if it was last time we met or the time before, we were talking about how the US market, the rally has been driven, of course, mostly by only a handful of stocks, the top seven or eight stocks.
Sometimes called the Magnificent Seven.
Yeah, exactly. And a lot of the bears out there would point to that and say, only these stocks are bringing the market higher, therefore when they fall, the whole market will fall. But as we spoke about not that long ago, well, they're thinking about it the wrong way. What if all the other stocks started to participate? Then you've got a broader based rally.
Yeah.
So the Russell 2000 is basically small caps in the US, the smallest 2,000 companies. And I actually find this really interesting. So that index did fall to the lows in October, like the broader market, whereas the S&P 500's traded up here. The Russell 2000 hasn't participated, but it doesn't look very bearish either. So to me, it looks like it's forming a very nice base, and it's on the cusp of breaking out. So it's not breaking out just yet, but I'd keep an eye on this one because obviously as investors get a bit more confident in the broader market, the broader economy, you'll start to see the Russell 2000 start to participate, and that'll give you a bit of an indication that the rally in stocks will be broader based, and the rally will be more sustainable in the market overall. So very interesting to keep an eye on this one.
Yeah, and I think when you look at the S&P 500 itself, and you do take out those big seven, the rise is not all that big at all, and that gives me a feeling that once interest rate rises are over, a lot of those companies have been punished because of interest rate rises could easily become more liked by the market.
Yeah, exactly.
Okay, let's go to the local market, ASX 200.
So this is a weekly chart. just once again, just highlighting that we've definitely lagged a bit here. We've held up a lot better than the US market in terms of sort of the peak to trough moves, but you know, most recently, since the start of the year, we haven't really gone anywhere. What I've noticed most recently, though, a couple of weeks ago, we had a very bullish move here off 7,000 to bring us back up towards the mid 7,300s. So that was quite encouraging. And last week we've managed to hold in up here. We haven't, as we've seen from the prior several weeks, a strong rally up on 1 week hasn't then been followed through by a bit of a wipeout on the week after. So far this is looking fairly constructive. We really need to get through this 7,400 level, and then we could start bringing 7,600 into play. So yeah, look, shorter term, just treading water at the moment. We've got CPI on Wednesday, US interest rate rises, a few things to keep an eye on. But once we're past Wednesday, I think we can see what the next direction will be. But overall, I think it looks quite constructive for our market as well.
I know it's only guessing, but my best guess is that if we get a better than expected inflation number, like the US did a few weeks ago, and the feeling is that we're getting close to the top, we might start seeing a little bit more positivity for our market. What do you think?
Yeah, definitely. When we saw the latest monthly figure, that was better than expected. And, you know, there's always something negative to point to. I mean, some people point to core inflation. It's interesting that the headlines of the papers say, you know, inflation on the way down, but it's still too high, so interest rates will still go up. But it seems like a lot of people don't seem to understand trends, and you're not going to continue raising rates until you get to your 2 to 3% band and then stop raising. So clearly they're trending lower. You know, our CPI lags that of the US. Core inflation seems to lag that of you know, the more volatile measures. So, but they're on the way down. So that's the important point.
And a lot of people forget that monetary policy works with a lag as well. So there could be a really big drop. And I actually compared charts of US unemployment to Australian unemployment, because that was one of the stories last week, that our unemployment remains high, therefore inflation is going to remain high. But US unemployment has not surged at all. As people have gone sideways after hitting a bottom, a bit like ours. So it's not beyond reason that our inflation could surprise on the low side. Let's hope so. Okay, let's go to our first stock, CSL, that has copped it in recent times. Is there anything the charts say this is a buying opportunity?
Yes and no. I think these are good levels for CSL. I think it can improve from here. I don't think it will shoot the lights out just yet. I mean, as we could see on this chart going back about 6 years now, we had that very nice run up earlier on, but ever since COVID, it's traded sideways. So on a positive note, it is at the bottom of that range, towards the bottom of that range. So you could treat this as a bit of an opportunity in anticipation it gets back to the top of the range. But whether it actually breaks out remains to be seen.
Would you be scared to buy here, Mike?
No, I wouldn't at all. I mean, one thing to bear in mind with CSL is it's a high PE growth stock. It's sensitive to interest rates. So if we think back to the last time the US Fed started cutting rates, that was back here at the end of 2008, and we could see that from this point to this point, we've got about a 50% rally in CSL. So I'm not saying rate cuts will do that, but it is quite sensitive to when interest rates start to get cut.
Very good point, mate. Let's go to a fellow health stock in ResMed.
Yeah, this one's, again, sort of like CSL, not really doing much at the moment. I mean, it's had a wild ride, but just looking back at this price level, it's the same as where it was in mid-2021. But we can see there has been a general trend higher. It's had periods where it's gone up a little bit too much. But generally it's been heading higher, and it seems to be back onto this uptrend line that we've had for at least 5 years now. So I think this would be a buying opportunity. it's at the right level. You could always sell it at a loss if it broke that line, if you're trying to run a stop loss. But again, it's not really going anywhere in a hurry.
No.
I think it'll do fine from here, but not a lot of momentum at the moment.
Okay. You've shown a bit of an inclination towards resource stocks in recent times. What are you seeing for S32?
I think this one's at a fairly interesting level as well. So you've got, it seems to turn around quite nicely between, these levels between about $3.50 and $4. But when I look at the candlesticks, there's a very powerful reversal signal here. So what you've had is a period where it's eased back in the first half of this year. Then a couple of weeks ago, we had this week here where it opened at this level here, initially traded to a new low for the year, but by the end of the week, it had made a massive rally. I mean, just by eye, it looks like it's done all, at least 10% from low to high, just in that 1 week, closing on its highs. And then last week, it's managed to hold on in the upper part of that level. So, from a candlestick point of view, charting point of view, that's a reversal, and I'd expect some sort of recovery from here. I mean, whether it goes up to these levels or whether you just get a bounce like that. If you're looking to buy South 32, that's the signal to say, okay, now's the time to step in.
Okay, well, that's the kind of thing we like to share with our viewers, mate. Now, this is not a company I have a great fascination with, but the analysts did like it, TPG. Yeah,
look, there's nothing I could really gain from, too much I can gain from looking at this chart. I mean, it's spent the past several months, not really going anywhere, sort of bit of a, you could call it building a base. It tried rallying a few months ago and looked like it was trying to get into a trend, but now it's back into this sideways range. So, very short term, it looks like it might try to bounce, but not too compelling at the moment.
Yeah. I was actually quite surprised that the analysts liked it, but it may well be they just think there's a good buying opportunity for a short-term gain because, there's no long-term trend that makes you want to be in that company.
Yeah.
Let's go to IEL. Now, a lot of fund managers like this company, and I did talk to an education expert over the weekend. He's not necessarily a great fan of the management of IEL, but he does think that with some changes in the industry, there's some positive winds blowing in their direction. With a lot more students coming in. He basically said they're more a recruitment of students type business than they are actually an education business.
Yeah.
I'd be interested to see what the charts are telling you, mate.
Not too positive at the moment. I mean, there was obviously this big drop at the end of May, and I think from memory it had something to do with their businesses in Canada.
They lost the monopoly they had in testing for people for English.
But what's interesting is there was selling before that news even came out. I mean, something I've mentioned on the program before is when you test a particular level, the more you test it, the more you weaken it. It doesn't make it stronger, it actually weakens it. So in this case, for the past, it looks like almost a year, the share price was testing this $26 level on a number of occasions.
Yeah.
It tried to bounce, but it continued to hit selling pressure, and it spent most of this time down near the bottom. So what that proved to do was just weaken that level. And the buyers near $26, that ran out, and then the share price fell. So, and I think we might have covered this one as well back in June, where the problem was you'll get some sort of bounce, but once it gets near this level, you might end up with a bit of selling, and that's what we've seen. So clear selling in mid-June, it's fallen away. It's trying to recover again, but I'd just be very wary of any sort of move back up to these levels. So what you've had is $26 as a major level. It tried to rally once it got to about 25. You clearly had a number of investors think, well, that's about close enough. Let's start selling. So my fear, if you're holding this, would be it starts to get close to 24 something, and then whoever's still holding it thinks, okay, well, I better not get too greedy because I don't want to see that happen again. I'm going to start selling before everyone else starts selling.
Yeah.
And you end up with these lower highs. So for this chart to look good, I think it needs to really sort of flush out all the sellers and start
break
again.
26 as well.
Yeah, if it can break 26 quite quickly, that would be a good sign. But I've got a feeling it'll just drift lower, and maybe in 6 months from now, it's all the sellings, everyone's given up, and then that might be the better opportunity.
Well, maybe in 6 months' time we might recommend it. QUBE Logistics.
Yeah, look, at a couple of interesting things on the chart. So this sort of reversal here was a classic sort of charting reversal, and it's got a number of names. A lot of chartists like to give names to particular patterns.
Yeah, you're such an exciting group of people, aren't you? You like to make these really interesting. Yeah,
exactly. But one of the names for this is called an evening star formation, and what happens is you have a trend heading higher, and then you end up with a gap up. And on this particular day, it looks like a cross or like a little star up in the sky. So what's happened is it's gapped up, and during the day it's gone a bit lower than the open, a bit higher than the open, but ended up just closing where it opened. So a bit of indecision there. The market didn't know really what to do with it. But then when it gapped down the following day, you end up with that reversal signal. And we can see a few days after, it still couldn't get back to that 325 level where it opened on that day. So this would have been the signal that clearly the uptrend's finished. There's a real lack of buying now, and that reverses the trend, and we can see it's now into the downtrend.
yeah.
Short term, you've got a bit of a sort of rectangular range here between 275 and 290. It's near the top of that. So look, I'd say if it can rally through 290 and close above that, maybe this is over. But I think for the moment, the risk is to the downside. It might just continue drifting lower.
Yeah, okay. We'll lock 290 as a time to think again. All right, Santos. Yeah, analysts like it. Oil price outlook looks pretty positive. But what are the charts saying?
Yeah, I like it. I've liked the energy sector this year. I mean, a lot of these energy stocks, Santos, Woodside, etc. It's been very choppy, and when you look at it day by day, it's hard to try to get a feel for the trend. But here on this weekly chart, we can see a bit of an uptrend starting to establish. So, a bit of a pullback towards the end of last year, early this year, but we could see it rounding out. And there was a lot of selling near about sort of 740, 750, but it's really started to push through that, and it's starting to gain momentum now. So I think there's more upside in Santos.
Yeah, and all the analysts agree with you as well, mate. Let's go to your selection, WHC, a coal company. There'll be people that say, how could you invest in coal? It's anti-climate change and whatever.
Yeah.
What are you seeing with the charts?
Yeah, well, if you just purely want to make money on the market, it almost doesn't matter what they do. Energy stocks. So I think we've had this period where, everyone was quite positive on the sector a year ago.
Yeah, look at that.
And then the coal price came down. Coal prices came down.
And the oil price was falling at the same time, wasn't it?
Yeah, and it got to a point where I think in the last few months, everyone's given up on the whole idea of investing in coal stocks. So, and that's what makes it really interesting now, because we could see, I could see a bit of investors sort of giving up here, especially at the end of May, only for the shares to bounce back pretty well. And what you've had is a very strong bounce off the lows. But instead of getting sold into and getting back into the downtrend between mid-June up until today, really, we've had this sort of sideways tug of war between the bulls and bears. There are those still giving up on coal stocks, but a lot of good buying demand. And today it's sort of popped up through a major level near $7. We had their quarterly results last week. Everything's in order. Again, these coal companies, there's no one investing in new coal mines. So supply is going to be very limited for a while. Of course, the froth in the in the coal prices come back from where it was last year with the Ukraine invasion, but it's not going anywhere. Where it doesn't matter what your views are on what should be happening with coal stocks and renewables and so on. The fact is they're going to be around for a while, and they're going to continue producing and making some pretty good profits. You only have to see that any excess money is used to buy back shares. They're not investing in new mines. That's very unpalatable. So I think they're in a good position to continue making money. As I said, the heat's come out of the share price. I think now it's time to get back in if you're looking to invest in this area. I can see this one. To me, it looks like it's starting to enter a new uptrend now.
Yeah, and the simple facts are it's a transitional period from the conventional fossil fuels to the alternatives. It's going to take time.
Yeah.
And then they're not going to walk away from generating energy. And apparently they've had a really mild winter in Europe as well. And that has actually helped the demand for coal to keep it down. But as the writer who I was reading over the weekend said, anyone who contemplates that European winters will always be mild is taking a very big gamble.
Yeah, yeah. So look, and all that sentiment's in the share price. So I think that's all baked in now, and I think there's upside from here.
And also with all those wildfires over there at the moment, I guess air conditioning demand is probably on the rise as well.
Yeah, that's true.
That's Mike Gable from Fairmont Equities. And that's the show for tonight. Thanks for joining us. Don't forget Boom, Doom, Zoom on Thursday. And of course, if you've got any friends or family who really need a leg up when it comes to investing, I don't mind if you talk about the Switzer report. Thanks for joining us. See you on Thursday.